The U.S. Constitution has been amended 26 times. The last time was in 1971, which lowered the voting age to 18. In recent years, it has been proposed that it should be amended a 27th time to enforce a balanced budget on the federal government. Is this a good idea? In this program, we take a look at the controversial issue of the federal deficit. We discuss, 1, what's bad about deficits, is there such a thing as the burden of the debt, and who bears it? And 2, what are the economics of the perennial proposals to enforce a balanced budget on the government? When an individual goes into debt, say to buy a new car, there's no question about who bears the debt burden, which is comprised of the interest and principal payments. Well, the government has these payments too, but one difference is that individuals don't live forever and debts are generally settled at death. But governments don't vanish, so it never needs to settle debt. It can continue to refinance debt by issuing new debt to pay off existing treasury notes as they come due. Well, then, of course, there are new debt service payments to be made, and interest payments on the federal debt have risen with the rising debt total. In 1975, interest amounted to only about 5% of the federal budget. In 1990, the interest on the debt incurred during the previous decade was 14%. A question, of course, is it fair to future taxpayers to up their burden? Although many think not, let's talk about it a bit. One consideration is whether the debt was incurred to finance consumption or investment. The government does invest in public facilities that last for years. It builds schools and military bases which provide education and defense for the next generation. It seems quite fair that the beneficiaries of these government services should bear some of the cost of the provision. Most everyone would agree that borrowing to finance investment that is expected to produce future benefits is financially sound. But many, maybe most of the items in the government's budget can't be classified as investments. The biggest item is the Social Security budget, and that's typically used for current consumption. Another thing to think about is the relative wealth of the next generation. Long-term economic growth and technological progress has made it possible for a more or less steady increase in the American standard of living over the past century. If the increase in the living standard continues, then a redistribution of income from the richer generation to the poorer one seems fair. And that, in essence, is what the rising public debt represents, a transfer from children to their parents. Now let's go back to the deficit and talk about the inflation tax and some other things that make it clear that it's not easy to measure the deficit. Suppose a very reliable person owes you $1,000 payable next year. And let's also suppose that there's an increase in prices by 10% between this year and next. Now what does this do to the value of your $1,000 credit? What happens is that it's reduced in real terms. That's because by the time you get your repayment, you'll only be able to buy 90% of the commodities that you could have had with the same money 1 year before. The same thing happens to the holders of government bonds in the presence of inflation, which reduces the real value of those bonds. In this sense, inflation is a tax on bondholders. And while this is a loss to them, it's a gain to the government. That's because the government could repay its debt with inflated dollars. Now, while this gain is equivalent to a tax, according to the established rules for budget accounting, it's completely ignored, but we can easily calculate its magnitude. At the end of 1992, the privately held debt was about $3 trillion, and the inflation rate that year was around 3%. So the inflation tax was $90 billion, or 3% of the $3 trillion. Since the official deficit that year was $254 billion, we should correct this number to include the inflation tax. The inflation-adjusted deficit was thus $164 billion, which is the $254 billion minus the $90 billion inflation tax. So far, we've been talking about the deficit of the federal government, but what about the state and local governments? From the point of view of macroeconomic theory, they have the same impact as the federal government. Their spending is also an injection into the spending stream, and their taxes are a leakage. At this stage, we generally ignore local governments for reasons of simplicity and also because they generally don't practice counter-cyclical policy. They are usually prevented from running deficits by constitutional requirements to balance their budgets, but their constitutions don't rule out surpluses. The state of Utah, for example, has been running surpluses, as have other states. These surpluses should be netted out against the federal deficit in assessing the macroeconomic impact of the public sector. You may remember the campaign of 1992. Ross Perot gained considerable popularity, but still lost the election with his attack on the growth of the public debt. All three candidates in that election, Bush, Clinton, and Perot, agreed that it was wrong to run large deficits and discussed plans to reduce them. Now, why is there this sort of belief? One reason goes beyond economics. There's an aphorism, neither a borrower nor a lender be. Political economist George Will reflected this opinion in 1985 when he wrote, "Deficits aren't economic, but reflect moral failure." Suppose a balanced budget amendment did pass and was enforced. This might satisfy many people's sense of morality, but would it be good economics? For example, what would be the consequences for the severity of the business cycle? The answer depends on whether the Keynesian model of the economy is accurate. If a balanced budget is imposed on the simple model, then it's easy to show that business cycles should tend to become more severe. So a balanced budget rule would be bad macroeconomics. It's bad because it removes an automatic stabilizer that's built into the net tax function. We can demonstrate this by calculating the Keynesian multiplier for three simple models. Remember that the multiplier measures how sensitive the economy is to external shocks such as sudden changes in investments, bad harvest, or war. When the multiplier is large, these shocks have a large effect on the GDP and thus on the unemployment rate. Remember that for a simple economy with lump sum taxes, the ordinary fiscal multiplier is 1 divided by the marginal propensity to save. But taxes are not lump sums, but depend on the level of income. For example, the federal income tax increases with income, and so do state income taxes. Then there are Social Security taxes on wage earnings and sales taxes on sales. So don't forget that T is defined as net taxes, that is, taxes net of transfers. So we should be subtracting transfers such as Social Security, unemployment compensation, and aid to families with dependent children. These are also sensitive to income levels. The combined income sensitivity of taxes and transfers means that taxes will fall whenever income falls. Now, when we take this into consideration, the multiplier effect falls substantially. For a linear tax function with a tax rate of 1/3, the fiscal multiplier drops in half. The implication of this lower multiplier is that the tax function, with its income taxes and welfare programs, has made the economy less sensitive to external shocks. This is called the automatic stabilizer effect. In an economy with automatic stabilizers, there is less need for government intervention to prevent recessions because of the automatic intervention effect. With a balanced budget regime, where we keep the same tax function and balance the budget by cutting spending, the balanced budget rule means that government spending must always equal taxes. Well, here's the way we might model a government spending rule. It's based on a linear tax function, T, which is equal to minus 200 plus 1/3 Y. This equation says that if projections show a decrease in Y, then G is automatically cut to satisfy the rule. Further, if Y is projected to rise, then G is automatically padded to satisfy the same equation. If we think about this, G is cut when Y goes down and increases when Y goes up. What we've done is to build an automatic destabilizer. In fact, if we do the algebra, we'd find the multiplier significantly increased. Stabilization policy has been less than perfect. The argument about the automatic destabilizer is one reason for opposing the move to force balanced budgets. But as usual, there's another side to the story, and this is called the fool in the shower argument. The Keynesian vision of stabilization is one in which the severity and duration of the business cycle is diminished, if not eliminated entirely. But some economists, Milton Friedman for example, have observed that government policy has often made the business cycle worse. Sometimes it seems that policymakers behave like a fool in the shower. At first, it seems too cold, so the fool turns up the hot water. But since the pipes are cold, the water doesn't warm much, so the fool turns up the hot water even higher and ends up scalding himself. Well, then reacting to the heat, he turns down the hot and turns up the cold. But there's an inherent lag as the cooler water makes its way up the pipes to the shower head. So he turns up the cold even more. The result is the water goes up too much. Instead of stabilizing the temperature, the fool effectively amplifies the natural temperature fluctuations. Now, why are government economists and elected authorities so foolish? After all, they are well educated, many have PhDs, they all know about the multiplier, and they have studied the macroeconomic theories that we've presented in this class. They've also had access to the very best and latest economic statistics, so why can't they get it right? Well, the explanation for such foolishness lies in three different kinds of lags. The first is called the recognition lag. This is the length of time required for government policymakers to recognize that the economy has strayed from its long-run equilibrium natural level. We've seen many different economic statistics in this program, but we've never seen one for the latest 3 months. In fact, our statistics leave off the latest few years. Government economists are able to do much better, but they will still be a little bit behind. When the Federal Open Market Committee, the FOMC, which is the policy-making group in the Federal Reserve, and the President's Council of Economic Advisors examine the latest data, they can be confused by the first evidence of an economic downturn. Is it the start of a recession, or merely an irrelevant statistical hiccup? A second kind of lag is the response lag. This is the time required for government authorities to decide what is to be done. In the spring of 1975, there was widespread agreement that expansionary policy was needed to bring the economy out of a recession. President Ford proposed a tax cut, and Congress rushed a bill through both houses in only 1 month. In this case, the response lag was quite short, but this has not always been the case. Oftentimes, there is considerable disagreement about the severity of the macroeconomic problem and the appropriate fix. Often, the wheels of government turn exceedingly slowly. Slowness was the case when Congress debated President Johnson's 1967 proposal to attach a 10% surcharge to the income tax. Unemployment was then at an all-time low, and inflation was beginning to accelerate. But Congress delayed for 11 months before agreeing to apply contractionary fiscal policy. For monetary policy, the response lag is usually shorter. The FOMC meets weekly and can give instructions to buy or sell bonds in the very same day. But there is another lag, the implementation lag. Well, this is the length of time required for the contractionary or expansionary stimulus to be seen in the GDP and unemployment statistics. Recall how monetary policy works. The Fed expands the money supply, and this reduces the interest rate. The lower interest rate encourages business to expand investment spending. An automaker begins work on a new assembly plant, and a rental car company expands its fleet of cars. Well, the lower interest encourages household spending too. Households may invest by moving to a new house or by buying a new car or some new furniture. They are concerned about interest rates if they pay for this new stuff with a home equity loan. Some economists say the misapplication of Keynesian economics is placing a large burden of debt on future generations of taxpayers. While this problem is not quite so bad as it appears at first, it's still important. One popular solution, the proposed balanced budget amendment, is not entirely a good one, because if it were seriously applied, it would institutionalize an automatic destabilizer. The country might still be better off with the balanced budget rule because it would reduce the chance that stabilization could be misapplied due to inherent lags, or due to presidential re-election strategies. This is just one of the issues about which economists argue.
Ladies and gentlemen, we interrupt this program to bring you important news.
It's hard to find a more controversial subject than the federal budget deficit. In this segment, we want to discuss the deficit and think about the following questions. How should the government's deficit be measured, and how is it related to the national debt? How is the government's deficit financed? What does the deficit have to do with monetary policy? How can macroeconomics help us understand the deficit debate? You might think that measuring the debt is not a big problem. Simply go to the national accounts and look up the statistics. Remember that we define the deficit as the difference between government spending on goods and services and net tax revenues. Whenever the deficit is a positive amount, which it has been since 1969, the Treasury makes up the difference by borrowing. That is, by issuing government bonds, 30-year Treasury notes, 3-month Treasury notes, U.S. savings bonds, and so on. The total value of all the bonds that have been issued but not yet redeemed is the federal debt. But the correct measurement is not so easy, and the official statistics can be confusing. At the beginning of each year, the President submits his economic report to Congress. In this report, which summarizes the budget proposal for the next year, he follows accounting procedures which are somewhat different from the national accounts that we defined way back before we began our discussion of Keynesian economic theory. Certainly, the President's budget includes spending and tax revenues, but he puts most transfer payments under the same category as spending on goods and services. This is different. Before, we defined G, government spending, as consumption of output only. Transfers, such as interest payments to bondholders, can end up as consumption of output, but it's not the government which decides how much will be consumed. For this reason, we had previously lumped transfers together with taxes in the symbol T, net taxes. Actual taxes, like the corporate income tax, are positive components of T, while transfers, like interest payments, are negative components. The largest of all the transfer programs, the Social Security program and its associated payroll tax collections, are not included in the President's official budget at all. These two large accounts and a number of smaller accounts are referred to as off-budget. In 1993, the official budget showed an on-budget deficit of $300 billion, while the off-budget deficit was actually a surplus of $46 billion. This means that the correct number for 1993 should be $254 billion, which is the difference. Okay, so what is the national debt? The national debt is defined as the current value of all the bonds, all of the borrowing from the public by the Treasury in 1993, and in all previous years. At the end of 1992, this figure was the national debt stood at almost $3 trillion. At the end of 1993, the national debt had risen to $3.253 trillion. The implication of this accounting is that if the President and the Congress had agreed in 1993 on a method of balancing the budget, and if they had decided to use the total of on-budget and off-budget deficits as their definition of balance, the public debt would have remained at $3 trillion that year. The reason we mention this is to emphasize the difference between the deficit, which is an annual flow of money from bond buyers to the government, and the debt, which is a stock of financial commitments which can be redeemed in the future. According to the rules of the American government, the President makes proposals about spending programs and tax law, and then the Congress debates these proposals and makes changes before passing legislation that gives the President authority to carry out the spending that's finally arrived at and to collect taxes. The Treasury keeps at these accounts, and when the taxes do not cover the expenditures, as they haven't for many years, the Treasury borrows the rest, borrows the deficit. Congress also has some control over the borrowing in the form of a limit on the Treasury's borrowing power, the so-called debt limit. In November of 1995, a Republican-dominated Congress and President Clinton were locked in an ideological battle over the budget. And in order to impose its budget plan on the President, Congress refused to increase the Treasury's debt limit. To prevent a default on Treasury notes that came due then, the President shut down the government for 6 days, furloughing 600,000 non-essential employees. For example, he closed all national parks. A similar shutdown occurred again in December of 1995. This chart shows the deficit, the sum of on-budget and off-budget deficits, as a percent of GDP. As everybody knows, comparing the dollar amounts of the deficit or anything across the years can be deceiving because of the distortions of inflation and of the economy's growth. It's like comparing apples and oranges. In this graph, which plots the federal surplus as a percentage of GDP, we see a noticeable downward trend. The controversy that surrounds the deficit centers on the question of whether the country can continue this trend or whether it should return to a balance. Well, what about the debt? Here we see the ratio of publicly owned federal debt also measured as a percentage of the GDP. Now, this is not the debt figure that President Clinton and the Congress fought over in November 1995. That was total debt. This is the publicly owned debt. We've deducted a rather large fraction of the debt which is owned by the government itself. As you know, monetary policy is practiced by the Fed's open market operations, the buying and selling of Treasury bonds, but mostly the buying. As a result, the Fed owns about 7% of the national debt. Should we count this as part of the debt or not? It's composed of Treasury notes held in the vaults of the Federal Reserve System, and these earn interest payments from the Treasury. But this is a lot like two pockets on one pair of jeans. The interest checks go from one branch of government to another. The Fed uses these earnings to finance its operations, but there's still some left over. This is returned each year to the Treasury, so we should not count the Fed's holdings as part of the national debt. An even larger holder of government securities is the Social Security Trust Fund. It holds about 1/4 of the debt. Should this be counted? It is an asset to the government in the sense that it can be used to pay future Social Security benefits, but it is a liability to the Treasury to which interest must be paid. This asset cancels the liability, and thus these securities should not be counted as part of the public debt either. Now, who exactly are the public? The table below breaks out the owners of the federal debt. We see that 32% is held publicly and 68% privately. Some people have become concerned that the public holders of the debt are increasingly foreigners. One reason for this concern is patriotic. Another is that the interest payments are leakages from the economy. In the table, we see that about 12% of the public debt is held by foreigners. You might be questioning the meaning of the term public in this table in light of the entry for state and local governments under private accounts. These are mostly the pension accounts held by state and local governments for their employees. The fact that a part of the national debt is owned by the Federal Reserve System raises an interesting issue about the relation between the Treasury and the Fed. What if the Fed were to purchase the full amount of the debt? This is what would happen when no one else would be willing to buy Treasury notes. Now, why would this happen? It could happen if the public had no confidence that the debt would ever be repaid. Such a lack of confidence would indicate a rather weak government. This is not the case for the U.S. government. It has never had any trouble selling all the Treasury notes needed to finance its debts. Lenders around the world have the highest confidence that U.S. Treasury notes will pay the promised interest and that they will be redeemed. In fact, when financial economists are searching for a risk-free interest rate with which to compare the rates of return on other investments, they often use the T-note rate as a measure of the hypothetical risk-free rate of return. But not every government bond from every government has this risk-free characteristic. In the recent past, the bonds of the Serbian and the Peruvian governments, for example, have been far more risky. So risky, in fact, that hardly anyone will buy them. What is the Serbian, Peruvian, and many other governments to do? Well, how can they pay their bill? The answer is that they print money. They simply order more banknotes from their central bank. The new banknotes are then used to pay the government's bills, for example, for salaries, for welfare checks, and for equipment purchased by the Armory. So, there are two ways that deficits can be financed: by borrowing from the public, that is, by selling bonds, and by printing new money. The technical name for the latter is seigniorage. The U.S. government relies overwhelmingly, but not entirely, on the former, borrowing to finance its deficit. But even though the entire amount of the U.S. deficit is technically borrowed, there is still a scenario in which part of the deficit is financed by creating new money. This scenario arises because of the linkage between the goods market and the money market, and because the Fed usually tries to keep interest rates from fluctuating too much. Recall the linkage between the two markets that we discussed several programs ago. There were two linkages that we talked about. One involved the sensitivity of investment in the goods market to changes in the interest rate in the money market. And the second recognized that an increase in aggregate income in the goods market will also increase the demand for money. Remember our basic result, that a deficit causes an increase in the level of income. Thus, a deficit implies a shift to the right in the demand schedule for money. When this linkage is complete, the equilibrium interest rate will rise. The rise in the income level is beneficial. Hardly anyone will object to this. But the rise in the interest rate is not so nice. Some people don't like rising interest rates. These people are likely to complain to the Board of Governors that the interest rate should be lowered. Such complaints are likely to come from industries which depend on credit financing, such as auto manufacturing and home building. It's often seen that car sales and home building decline when interest rates increase. In 1980, a national organization of realtors organized a campaign against the very high interest rates of the day. The housing industry ran an ad urging people to send the keys to the house they could not afford to Paul Volcker, then the chairman of the Board of Governors. Volcker received thousands of keys in the mail. Let's look now at the link between monetary and fiscal policy from a different perspective. Suppose that, for whatever reason, the President and Congress decide to increase the deficit, and hypothetically, the Fed succumbs completely to political pressure to peg the interest rate. We then will show that this is equivalent, at least partially, to the situation in third world countries in which the not at all independent central banks simply print more money to finance the government's deficits. Well, how can this be? The two situations seem totally different. And isn't the U.S. Treasury required by law to borrow all the money needed to cover its deficit? But what happens is that the Fed ends up by buying government debt to control the interest rate. If there's an increase in government spending, there's an upward pressure on interest rates in the money market that comes from an increase in demand. If the central bank wanted to maintain a given interest rate, that could be accomplished by increasing the money supply. It's not that the Fed actually prints money, but by pursuing the goal of constant interest rates, the Fed does essentially the same thing. It expands the money supply by buying government securities on the open market. The result is that the Fed ends up owning part of the new debt. To what extent has our Fed monetized the U.S. federal debt? We can examine this question with another quick look at statistics. Here we plot the federal surplus, which is negative since we're talking about deficits, and the change of the monetary base. That's the sum of currency and the Fed's holdings of government securities. Both are measured as a percentage of the GDP. The change in the monetary base is the part of the deficit that's monetized. It's clear that the deficits, that's the increase in the debt, have been much greater than the changes in the monetary base. Clearly then, the U.S. Fed has not been monetizing very much of the U.S. federal debt. Instead, the U.S. has relied overwhelmingly on private citizens to lend the government the cash it needs to cover its deficit. Now, what we haven't done is to discuss the issue of whether or not deficits are good or bad.